Hi, everyone. This is David from Aleph. We're going to give people a couple minutes to get settled, join the webinar. But while you're doing that, first, welcome. If you can put in the chat just a quick idea of where people are calling in from, that'd be great. We're excited to have you all here. We'll give probably a minute or two before we get into intros, but feel free to use the chat. Tell us where you're calling in from. And also, if you have questions that you want to make sure we're covering over the session today, please feel free to drop them in the chat. And we'll give them a couple of minutes to do that. And then we'll be back in just a minute or two to start with the intros. Neil, nice to meet you. I'm also in Austin. Well, hopefully we've got some nice coverage across the US. It looks like we've got, Calgary. Okay. Oh, India. Wow. UK, we've got people from all over the globe calling in. Awesome. Let's see, Cleveland, Chicago, a couple of Londons. Awesome. Excited to have you all here. We'll give everyone another minute or so, and then we'll dive right into intros. Got a little bit of the Bay Area coming in. Great. I see a Florida in the chat, Ohio. Awesome. All right, we'll give everyone about 30 more seconds. Another London, awesome. Alabama, awesome, Michelle, great to have you here. Another Florida with Doug in St. Pete. Awesome. All right, everyone, let's go ahead and we'll get started with intros. I know we only have about 45 minutes together today. So first, and I see some questions coming in. Great, Ayush, awesome. So let's talk a little bit about the structure for today, and then we will do some quick intros, and then we'll just dive right into the content. But for context, I'm David Rappaport. I lead the fractional CFO channel here at Aleph. Joining me today are Johnny Walker and Riya Grover from Sequence and Rooled, respectively. And today we're going to talk about the usage of usage-based pricing in the AI era, which is very top of mind for all of us here today. First, thank you all for joining us for the session. We're really excited to have you all. As I mentioned at the top of the call, feel free to use the chat. Tell us where you're calling in from. Also, as we're seeing in the chat, feel free to drop some questions in there. Our marketing team is manning the chat and will be available to submit those as we go through the Q&A process. But to get us started, what I'd love to do is kick it over to Johnny and Riya to do quick intros of themselves. I'll do an intro of myself, and then we'll get right into the content. I think we're going to end up with a lot of questions here today. So with that, Johnny, I'll kick it over to you, maybe an intro of who you are, why we're here, and then we'll go to Riya next.
Great, thank you. Well, I really appreciate the chance to join the conversation today, both with you, David, and you, Riya. I am one of the directors and co-founders of Rooled. We're an outsourced accounting and finance firm. We used to be called Temp CFO. We've been in the business for a while. And we handle everything accounting all the way up through FP&A and CFO. And we focus exclusively in the venture-backed market. I'd say I think it's commonplace for everybody that would be listening here, but the tools and technology has evolved rapidly in the course of the last 3, 4, 5 years, and certainly the last, I might even say 6 months. So I think it's a particularly exciting time to be part of this. And so over to you, Riya.
Thanks very much, Johnny. Hi, everyone. I'm Riya. I'm co-founder and CEO at Sequence. We are a billing order-to-cash platform specifically designed for companies who have more complex pricing structures. Most of our customers have some type of usage-based pricing. And so we've really seen this dramatic shift and change in the way companies are pricing from the perspective of being the infrastructure that powers their ability to actually bill for usage and be able to implement these pricing models. So super happy to share our notes and observations on what we see broadly in the space. I'll try my best not to talk about Sequence too much because I think that's less interesting, but rather actually to talk a little bit about some of the aggregate trends we're seeing across our customers, some of the challenges with implementing various different types of pricing models.
Awesome.
Great
Thanks,
to be here.
John and Riya. Just a quick intro of me. As I mentioned, I'm David. I run our fractional CFO channel here at Aleph. Aleph is an AI-powered FP&A tool that's used across companies of all sizes and across fractional CFO and FP&A shops, including Johnny. So thanks, Johnny, for being part of our group here today. My whole background, I've actually been an early-stage finance employee at 4 different startups, ranging from pre-revenue all the way through like Series B and beyond. And so the content here today is really shifted a lot of how at least I've done my work historically working inside of the firm. And it feels like every single day we're experiencing a new development in AI or pricing models. And so just to set the scene of what I'm hoping we accomplish here today and what you as attendees can help get out of this is first, like we want to talk a little bit about this shift in the market that Riya already mentioned about how seat-based pricing used to be the default. Now everyone is talking about usage-based, worried about their AI costs, both internally as well as on the customer side. We'll talk about auditability and how do you use that information in real time and how do you set up your stack to really like think about that prospect. And then what do you do with that? How do you forecast it? How do you think about the variable part of revenue without breaking your model? And really what good and great can start to look like as you're growing and scaling your teams in this world of things that are changing every single day. So with that, just a quick reminder, use the chat. Our marketing team is manning that. We'll do Q&A as we get through the process. But Riya, where I'd like to start with you is you mentioned at the start of it is like, let's talk a little bit about just like the market shift that you guys are seeing, that we're seeing in the broader market. And let's just talk about like what's changed and how quickly it's changing and what you're seeing across your customer base. And let's start there.
Sounds good. So many, I'm going to try and pick out some of the more salient ones, but I think the first thing to say is that definitely hybrid models are what we see most commonly deployed. It's pretty rare that we have somebody that is just usage-based or just subscription-based. These pricing models are often used in conjunction with one another. We very often see platform fee plus usage overage or even committed package with potential discounts as overage levels increase. We sometimes also see just quite simple tiered usage-based pricing models with minimum commits. I think really what people are trying to achieve with the hybrid pricing structure is enabling capturing upside whilst also mitigating downside and having some predictability in revenue. So I think hybrid models, that's the first point. I think like the reason we're seeing obviously so much adoption of usage-based pricing in AI, it's actually not just that obviously you're paying a usage-based charge for the infrastructure layer, right? For the tokens you're using with Anthropic or with OpenAI, et cetera. It's actually, I think, not for that reason. I think it's the fact that in most cases, a lot of AI products are untested and it's unclear yet what value is going to be delivered. And so this notion of, well, buyers, you can pay for what you use, it feels inherently fair. And one thing I really believe about pricing is actually like the right pricing model is all about what inherently feels fair to customers. And for a long time, seat-based pricing was the default because, well, it feels fair. Like you have more people in the organization using a product, and well, it makes sense. You pay incrementally for each additional person that's using it. And actually that used to work really well as a correlate with like approximating roughly how large a company is. And so you also had companies like I think Workday, et cetera, who didn't quite use a seat-based model, but they tied the amount you pay to the size of company you are. Again, inherently feels pretty fair, right? You're a Fortune 500 company, you pay a certain amount to use this platform. You're a much bigger company. So that, I think, with AI products, because value is unproven yet, people don't necessarily yet understand how much value it's going to create. The idea of like enter with the frictionless approach of just having a pay-as-you-go approach, and this really aligns incentives on both sides. And ultimately, that low friction entry point is, I think, really attractive for sellers as well who are trying to get people in the door quickly.
Yeah, super helpful there. I guess maybe Johnny, especially what you're seeing at early stage and venture-backed companies today, going off of what Riya said, like how are you all partnering with companies? How are they thinking about this like hybrid pricing model that Riya's mentioning? And what are you seeing also in the clients that you guys are working with?
Well, I agree with everything that Riya just said. I think so the perspective that I guess we'd bring to it is that we have, I mean, even if I broke it into different categories of clients, and we think that's most easily or defined as size or stage in financing. So Series A, Series B, and then seed. And so if you look at those clients that are currently at or have been at Series A, Series B for 12 months plus, well-funded, that have an annual subscription type model right now, typically selling to enterprise type clients, I think you're not seeing a great evolution there yet. I mean, from what we see in the market. You're seeing some. It's like, I think it's various baby steps almost, but that's a traditional customer, very entrenched in the way that they do things. They're very familiar with, I think, the annual subscription type format. And so these companies are still working, I think, predominantly through that business model and from the clients, something that I have access to or some visibility of. I think that's a contrast with the smaller clients, smaller companies down at seed stage. And seed stage is naturally a place where there's a lot more noise and variability in that business model as it evolves, that they're still trying to figure out what's that product that's actually got the scalable proposition. And so I think things do just always have done. The contract types, the billing models, everything bounces around a lot at the seed stage. And I think that's right now, there's a lot of AI native companies that are building out, that are at that seed. I mean, it's an extremely well-funded space right now, AI, venture capital funded AI companies. And so I think there's a proliferation of that. And there's and they're trying to figure out what the right business model is for them. They're trying to be competitive. They're trying to differentiate. And I think that's comparing against the more traditional annual subscriptions, enterprise level. So I think I do break it a little bit into those categories. And I think the AI native stuff is, well, actually, I think what Riya said there, it's very true that their cost base is tokens based substantially, and that translates quite neatly or directly to the way that the customer uses the product. But I think that all this talk about what the customer really needs is an outcome that you're then pricing for that value. And I think that's where there's a really interesting, because it's now so transparent what it costs to actually get that product or service or whatever that result is for the customer. Because it directly relates to cost, so you've got to have that revenue then be matched to it. Then I think you've really got this environment where that outcome is it's going to be much more possible and important to price on that outcome, I think. So I mean, I haven't seen that's like we've seen people get that right yet. I think this is just evolutions or trends in progress.
That's really interesting. I feel like all of the things you guys both said is really interesting, of like people understand that now, like they're incurring tokens. And I still think for a lot of end customers buying a product, you don't actually know how many tokens you're using or what is like the most token intensive work, or even what models maybe are like supplying the software that you're buying. But I think Johnny and Riya, what you're both saying is people's expectations have changed a lot. And as especially an early and mid-stage company, you have to meet the clients and your prospects where they are, and you're trying to make the sales process as seamless as possible without leaving too much value on the table one way or the other, and protecting your cost. And so I guess like the thing that I think about a lot is like an early stage company is going to change their pricing model or change their pricing structure or change the terms or the amount multiple times throughout the course of the journey. And that can create like a pretty large like overhead lift in how you manage this process. I guess like Johnny and Riya, for either of you, how do you kind of like think about working with companies knowing that what you're proposing today on Wednesday, May 27th may be completely different than what you go to market with next Monday or the following Monday? Like, how do you think about setting the structure of these teams up for success, knowing that things are going to change rapidly?
Riya,
I'm happy to weigh in a little bit. I mean, I think that there's like most companies today actually do change pricing quite frequently. So this shouldn't be perceived as this multi-month or multi-year product. But it is important, I think, to think about what needs to change if pricing is going to change, and kind of how to implement that well. So if you're doing any type of variable pricing model, like usage-based or outcomes-based, you obviously want to know which value metric you're tying what you're charging to, and actually be able to track those events in your own system. It's generally the case that if you're thinking about charging for it, you are tracking those events, but obviously that's an infrastructure requirement. And then obviously you need to use a billing tool or a revenue tool that can handle usage-based pricing well, and the different flavors of that well, to really stress test for your specific model and use case. Can they actually bill for what you're trying to do? Then there's also the people piece, right? Your sales team are going to be changing the structure of the deals that they're selling, and that's going to have significant implication downstream for finance across a number of different work streams, including reporting and revenue recognition. And so I think ensuring that alignment is there, and we really understand what's on the table when it comes to deal terms that can be utilized and contract structures and optionality around your new pricing model, I think it's really important to have alignment there, because otherwise finance get deals thrown over the line and actually it creates additional problems downstream. One of the reasons we see a lot of our customers use a unified CPQ and billing engine is for that reason, where there can be that closer alignment between sales and finance.
I'd say is that in support of that, the perspective also that we bring is that usage-based pricing is not necessarily, it's not really new. Like the concept of actually pricing or having something that the customer pays variable according to the usage of the product. We've done a bunch of healthcare or coaching or mentoring advisory companies where that demand on demand is at the customer's behest, and so they then request the services, and so that has to get passed through, and then there's a cost for the actual variable consulting service, whatever they take advantage of. So those models have always been there, but I think that's granularity or volatility, which is more manageable using the existing like spreadsheets. I mean, that's what everybody gets into as they're building out their company. Everybody just goes straight into spreadsheets, and you just got to do the best you can with what you've got as leanly as possible in order to get a result. And I think with those businesses that the granularity of what's happening is being coarse enough where you can manage it. I think here, now that you've got these businesses and there's a lot of different tracks of costs getting incurred in a given customer relationship, that customers are probably going to expand pretty rapidly, that AI usage, that tooling is going to change in price pretty dramatically too. You're seeing this with OpenAI and Anthropic, that they're figuring out what can they do with the pricing in the market. It's a lot more difficult to track this stuff and to do a good job of it. And so what it's always been a hard thing is like, what is that point at which you can insert a quality platform or tool that then solves the problem? And so I think what's really interesting right now is you've then got this ability with tools like Sequence and certainly with Aleph, you got that ability to insert them early. And then you can really, as you evolve your business, you're doing it on top of a tool set that provides that scalable infrastructure, which I think is critical, we see, for efficiency with clients.
There's actually a question in the chat, which might be interesting to touch on here, which is what's the best practice to calculate the ARR for usage-based pricing? We actually wrote a blog on this a while ago, but I think what we typically see, ultimately you have to make a judgment call about how conservative or generous you want to be. And I think consistency is really important. So you pick and you retain with that approach. But I think one fairly sensible thing to do is split out your total ARR between committed ARR, your contractual minimums, your platform fees, etc., and your consumption ARR. So make sure it's like really clear that those two buckets are separated. And then I think on the consumption piece, like coming back to this point of like, you have to make a judgment call. You basically have to pick an annualization approach and stick to it. And that could be your last month times 12. That could be trailing 3 months times 4. That could be some of the last 12 months. I think there's no like one right approach. And I think generally what we see people do is align with their board on what a sensible and reasonable approach is for that company and what they do, and to go from there. Not sure if you have anything to add on that, Johnny, David.
No,
Good, Johnny.
I would just say that what I shoot for is transparency. So I think always report ARR or these recurring metrics and then be transparent about how they're calculated. And I think the challenging one, I think in what you're saying there, Riya, is that whole concept of recurring. So something might happen, but then how can you attribute to that something the likelihood that it will happen again? And so that customer, the way that they're using the tool set, I think you've really got to understand in much more detail what they're actually doing with it, what benefit they're getting from it.
Yeah.
So then you could actually project on recurring. I think the whole
totally.
Customer success is going to be, I think, an even more important.
I mean, there are some businesses as well where like it really depends on the nature of your business. There's some businesses which technically do charge based on usage, but actually have a huge amount of predictability in what their customers are going to consume, almost as if it was a platform fee, versus others which have a ton of seasonality. One interesting observation I've seen from my own board meetings is I think historically people used to view usage-based revenue as like dirty, unpredictable revenue. Like contracted recurring revenue is fantastic because you know exactly what it's going to be. But usage, it's like, I don't know, it could just go away. Actually, I actually see the opposite now where because we have a usage-based component in our pricing, investors are really excited about the potential upside that can drive for us. And there's more upside opportunity available. So I actually think transparency, but also like building the right story about why you report your numbers that way and what upside is baked into that pricing model, I think is very important. I think finance teams should play a really important part if obviously framing that for the CEO in the board meeting.
Yeah, really good question there, Maddie. And I think the color I would add too is what you mentioned is like things have changed as like how usage-based revenue and ARR has been thought about by boards across venture-backed companies in particular. And the thing that I've always indexed on, what Johnny said is, we're going to footnote it. We're going to clearly define what ARR is. If we ever make a change about what that definition is, like there's a whole special topic at a board meeting to talk about it and the implications and getting input from your investors before you go roll out this change. And also realizing that knowing that you're going to talk to a bunch of other venture funds, and how do you have something that is defendable, transparent, easily trackable, so that at a moment's notice, it's not this like back of the napkin math of how I got to ARR. And then on the revenue side, like making sure that there's really clear accounting policies about how we're going to recognize certain parts of the contract. I'm not a CPA, not an accountant, but I know from my friends on that side of the house that that's a really important part of the process too, especially as firms are growing. So I'd say, Maddie, to your question, it's a really complex topic, and it feels like there's no one size fits all answer that we're going to give you today, but it's a really close coordination between your leadership, your investors, if you have any, understanding what really like market expectations are, talk about how you define growth level metrics like ARR. And then just to go like maybe one click deeper into Adam's question and add some more complexity, we've talked a lot about the revenue side of usage-based models and the token costs and how you pass that along to clients. But Johnny, probably more for you is like, there's also just token costs of now running companies and running teams and an R&D spend, and how do you segment the two between what's customer facing versus what's internal, and how you're starting to think about forecasting those either like differently or similarly. And just want to like pause there and say, like, how do you advise companies in this world where you may not know what your cost structure is? I think what Uber said last week, that like they've spent all their token budget for the entire year of 2026 by May of this year already. And so how do you advise growth stage companies on this like changing dynamic?
Yeah, but I'm not really sure I have a very credible answer to that, because I think we're still, frankly, figuring that piece out. What I would say, though, is that you had in the years and whatever up to now, the ability to cycle on, once you get the financials closed, then you've got this on a per vendor basis. That vendor is usually quite linked to one activity. And so you then, with that detail in it, and especially with tools like Aleph that make that very easy to get, then you can forecast out, and usually you're talking to one person for some perspective on that vendor. And I think now you've really got, I think to your point, you've got this very blended usage across different departments or groups in the company that all go into one consolidated vendor. And I think we're going to be looking for more detailed reporting that comes from that vendor as to where and how and who's actually using the stuff. So I think you're going a next level beyond just what was paid or what was billed to what's the underlying components of that. We've done that with, I mean, that's not that this all is very reasonable. We've done it with fintech companies that use FBO type partners, and there's a lot of different transaction costs that get incurred by these platforms. So the whole principle of it is not impossible. I think you need to get there. And then frankly, what we've seen as an outsourced service in years past, I think there's frequently a barrier. There's like your finance as an outsourced provider, you are limited in how much perspective and contact you've got in the firm as a whole. And so you might have a point of contact that's kind of giving you that broad brush strokes in terms of forecasting and whatnot. Now, I think we're moving into a world where you have to have that direct linkage into the different departments, into marketing, into product, into R&D. So you've got a much better perception of where that work is happening and what the likelihood is for different product rollouts, customer success and marketing and lead gen and whatever. I think it's now, in order for us to deliver that elevated service, it behooves us to be in contact with more of the company. And I think the tools necessarily support that. That's why we've been a huge supporter of Aleph for 2-3 years now, because it gives us that framework that gets us into the rest of the company. And we've got those data sources that we can then use to extract information and go and ask the right questions. So I think the tools are there. I just think it's an evolving challenge on our part to respond to the market.
Yeah, great. And I see a couple great questions coming in through the chat. Please feel free to keep adding them into the chat, and we'll try and pull them in at the right part of the conversation. I think, let's see, Taylor had a question about consumption and multiplying by whether it's the last 12 months or last quarter. Riya answered there, so that's great. The last one I'm going to ask about ARR for right now, and then I want to move more into kind of Johnny's point, which was around like tracking, visualization, forecasting, which is I think is why a lot of people are here. So Neil asked, how do investors kind of think about ARR and valuing it on usage based? Riya, I think you kind of covered it a little bit. Is like, do you see from clients and customers that you talk to, is it like similar to CAR or like the old definition of ARR, which was just simple as like annual recurring revenue, or maybe Johnny, as your clients are going out and raising some money, or is that usage based getting discounted? Like, what are you guys kind of seeing in the market and the approach to this like valuation of usage based ARR?
Yeah, I mean, I think it's a very valid question, and I've got into 2 fundraisers now, and like obviously had to sit opposite the table as investors have tried to understand how our revenue is made up. Again, I think it really comes down to that like narrative, and if it makes sense to charge based on usage, given what you do, you can bring predictability into that with things like minimum commits or credit packages that draw down. If you feel predictability in that revenue is really important, but you might just be in a really stable business where I don't know if you're selling cloud services or you're in the data centers business or something, like actually like, do you need to put those minimum commits in if you have a fairly reasonable assumption about what your demand is going to be? So I think it really does depend on what you're doing and what the right story around it is. And usage-based pricing doesn't necessarily mean that you have no predictability. As I said, there are all of these devices to enable you to have that predictability in spend, but be able to capture the upside from overage.
Yeah, I think just the last question we'll go here, and then we'll go into the operational side. I had a quick follow-up. If you see usage and minimum based on performance metrics over, let's call like a multi-year term, how do you factor this into CAR? And I think, Riya, maybe what I'm hearing from you and Johnny is it depends. And it really depends about like what your contract structure says. It depends on how predictable the usage is or what the provisions and how you do your billing is. Does that sound fair of what you guys see across your clients?
Yeah, I mean, it's a great call out, and like it's like an edge case, obviously. I have to make a sensible judgment call and stick to it. So yeah, like, I mean, multi-year contract with escalating minimums tied to performance metrics has a contractual floor, i.e. the minimum is real and enforceable, and then it has this conditional ceiling where it only steps up if the customer hits certain milestones. So you can't really treat that full contract value as CAR because the step-ups are uncertain, but you can't ignore the escalation either because it's contractually committed. Yeah, I mean, like, honestly, I think there's like probably, if you went to Claude, it's going to give you 5 or 6 different ways you might want to treat that edge case. And I don't think there is a right answer. I think there is a like judgment call that you have to make. And again, to Johnny's point, be extremely transparent with your board and internally with your leadership team about the approach that you've taken and why.
Yeah.
Great. Really great questions. Keep them coming in the chat. I want to shift more to the operational side of the house, and Johnny, kick it over to you. So you touched on a little bit about like the visibility of token costs, usage costs among like both internal use cases as well as client-facing work, and talk a little bit more about kind of the process that you saw this evolution of usage-based pricing come across in your clients today. Like, what was the manual workflow before things like Sequence and Aleph kind of came to the table, and like the work your team was doing, which I'm sure a lot of FP&A teams are doing today? And then what does this look like in this next journey where you do have the right stack in place, you have your team with the right ability to pull data? So let's kind of like go onto how your team and how FP&A teams across this entire call are working today.
Yeah, I think I'd say it goes back to this, what I call the principle of visibility, or the accessibility of the data and information or context within the client organization. And again, in years past, before tools like Aleph and Sequence and others turned up, we were pretty limited with what was ending up on the cash ledger, and then the schedules that we were building out, which of course would relate to things like customer contracts and whatnot. but your limit, your horizon was really at the finance side. And of course, with some clients, you had a deeper relationship, and so you had a bit more visibility of what was going on. But it was all dependent upon using somebody else's time to get answers to questions. And there was never really very easy access to data. And so I'm talking very broad strokes here. So I think you had it in the first instance, you had with all the platforms and tools that were just being implemented in the cloud, you had this provision of access to the data through the API. So that emergence happened 3-4 years ago, whatever. And so you had this ability to get data out of stuff. But then, of course, you needed the tool sets in order to get that and make it easy. And I think that's where Aleph really captured a unique proposition and a way that provides a tool set to us that allows access to that data. And then it's like we don't really need always the interaction with the other executives at the firm. Like we can start to make determinations ourselves based upon the data that we're seeing. You can start to test the philosophies or conjectures around that to say, okay, well, are these different tracks or data metrics linked together? Can I make an assumption for them in a financial model, etc.? And then you can, of course, go and actually test those by talking to the people directly. But you're able to extend the validity of what you're doing, and you're able to do it on a finer timeline too, because you're not stuck waiting for the month end. Like you're seeing real-time data that I think you can start to really work with and use on a much more interim basis. And so those would be the things I think that are generally changed, and certainly has made our job more. You're not just stuck when that month closed. I think there's a lot you're doing in the course of the month, and then the extent of our visibility or the horizon into company operations just is much greater now. And the challenge is really to take advantage of that.
Yeah, I think, and Rio, we'll come to you in a second, but I feel like earlier on in my career, the first thing you kind of logged into was like the bank account to see like the transactions that had posted from the prior day and like do your reconciliation. Now I feel like so many internal FP&A teams have to sequence their Claude dashboard, OpenAI dashboard to look at the spend from the prior day, because things can change so quickly and you can incur massive cost swings kind of from day to day. And really having that visibility, and it's not just the visibility, but I think also like the so what analysis out of this of, was yesterday an anomaly and we had 5 times X number of new customer signups, or did we onboard a new customer and they were going through a large implementation? Like Riya, how do you advise your clients to use this like real-time monitoring of their token costs, their usage costs, to think about what they do like day in and day out?
Yeah, it's a great question, and I think I'm going to generalize here, but I think generally we see companies sitting in 2 buckets. If they're an AI native company, they started recently, they're selling an agentic product, which entirely leverages a model under the hood. It's not necessarily that they're cost plus pricing, like they might be doing outcomes-based pricing, but they recognize that like essentially their biggest cost input is those model costs. And so they're watching them very closely and they're optimizing for those costs from a dev perspective, and therefore they're tracking them. And they're also obviously thinking about the right pricing structure as those costs move. What we then see is another camp of companies where they might be a more traditional software business or another business, and they're starting to bring in AI-based features and capabilities. The value that their product delivers may or may not be inherently tied to those capabilities. So it's like you're bringing in chat experiences or natural language-based ways to be able to take certain actions within the product. And I think there are certainly cases there where actually like you're not charging more for the product because you've enabled those capabilities, or you might be, but very incrementally. And there is potential that costs are running away there. And so I think it comes back to this point of usage tracking, both on the token side, but also on the customer usage side is really important. Like it's critical to know how customers are using your AI products, because you want to know whether they're delivering any value or not to your end users, but because you really need to understand how that's correlating then with your cost structures.
Yep.
Yeah, and I think Sublime, there was a question there about like as the cost structure changes, what we see a lot as well is that it's not just on the FP&A side of like monitoring the costs and understanding what's going on. It's actually now a dialogue back to product and engineering teams about what models are deployed in production, what the cost structure of that model is. Are there other comparable models that can be deployed at maybe a lower cost when the next version comes out? Like, it feels like we're playing like this new version of 3D chess in terms of it's not just what the latest and greatest out there is, but actually what's the right fit for your business and what's the right cost profile.
But I do think a finance leader in the org can be an orchestrator of those conversations, because everybody's looking at this from a different perspective, right? And might not really be triangulating across those things. So to your point, devs are looking at this stuff all the time from an evals perspective and figuring out which models to switch in and out. And as part of that, they're probably also looking at the cost of those different models.
Sure.
But that isn't necessarily translating into the pricing discussions that are happening, because they're looking at it from a different perspective. And so I do think finance have a role to bring this conversation into the room and make sure actually all of those different people who have a piece of the information we're actually pulling that together.
Yeah, no, great point. I think your point about being the orchestrator is really important, of bringing the right people together at the right room with the right conversation, not just, hey, our AI usage costs were 3x last month. What happened? But actually, like, let's dive into.
And also, it's not just a conversation of like, what are your AI usage costs, right? Firstly, it's like, what are your AI usage costs across different things, both internal and external, right? Like, and actually like figuring out whether that is driving business value or not. And actually, even what your internal strategy and policy is on this stuff. You might say, actually, I don't care how much my internal teams are spending right now, because we're still in an experimentation phase. I don't want to inhibit use at all. You might actually have a very different strategy because you're driving towards profitability next year, and like this stuff really matters. And so I do think like asking those sorts of questions of like, actually, like, what is our philosophy? What is our strategy on this stuff? And similarly with the use of AI in your own product, I think it's like very important to understand now for PMs, but also finance leaders, for particular, not all AI is the same, right? Like for different types of agents I'm building, what is actually the consumption cost of those to us as a business? And is that justifiable? Can we actually reflect that in our pricing, or can we deliver enough ARR growth to account for that? And this is the stuff where like, if you're not asking it, obviously this is obvious stuff, but it might just go unsaid, right? And like everybody's like building cool AI stuff, but like nobody's actually asking this question. So yeah, I think that we've talked a lot about how the finance team's role is evolving, but I actually think asking these types of questions can bring a lot of value to a business today.
I think, Johnny, let's come to you and let's talk about, like, I think we analyzed a lot of like past spend, cost structures, all of that. Now let's put it into practical steps of how do we forecast this? How do we think about costs in the models and understanding growth rates? Like, give us the inside scoop of what you and your team are doing today in these AI first companies. Is what you go into a forecast with may change rapidly. Like, how do you navigate this new world?
Yeah. Well, I mean, I think, and it's always the case that you did have, so I wouldn't say different approaches, but the approach subtly varies between different scales of companies. So I think with Seed, you could spend a lot of time and effort trying to really hone a very accurate, or else you could say, well, we know we're going to end up within this realm, this range of what in terms of costs and vendors and whatnot. And you have to give them, or you have to work towards what is a reasonable burn rate. And overall, as a result, once you've gone through all the expenses and revenue forecast and everything, you have to get something that's like a good broad bracket estimate on what's going to happen. And of course, there are assumptions in there. I think a lot of it is about ratios a lot of the time, like what's the proportion of that vendor's cost attributable to something else? What number of people do you have on the team, and what's their likely usage on certain tools and vendors? I think those are all pretty standard ways to do it. I think once you get, and again, because seed companies still are at that point where they're iterating almost continually on the business model and the different types of the products, the contract types, the revenue model, what's actually being sold. Like there's so much variability in what's going on that I don't think it just isn't feasible or sensible to drill everything down to like the nearest cent, for example. That changes once a company's got established that product, there's a scalability proposition, and then there's a go-to-market action that they're really investing in heavily at the Series A typically. And I think there, you've developed an understanding for how customers are using the product. And that's where I think perhaps the depth at which people had to go to was here before. Now you've got to go to that next level down. Really, I mean, to Ria's points, really understanding how people are using the product, what value they're getting from it. That's all going to lead to a better understanding of what that forecast in the short-term future and the longer term is going to look like. And you've got to be able to, every time in forecasting, you have to be able to compare what you thought was going to happen with what actually happened. And so if you've got these assumptions that say, okay, well, we attributed this total vendor cost to this way that customers are going to use it and this way that internal employees are going to use it, well, you have to then have that corresponding data for the actual site to then look at it and say, okay, well, my assumptions were out because of this. And then you revise the forecast. And you continually go through this iterative cyclical process on a monthly basis. So it's not going to get away from that being monthly. And that gives you that, we've now tested and validated that assumption structure and then the numbers that we actually have in there. But it does, you need the data and you need to have developed, and it needs to have been enough scale of operation of the company for you to develop a model around it and to have the actual data you can then compare against. And I think I think we're still, the ink is still drying on all this stuff. It's not related to Ria's points about AI native companies. Like this is really, a lot of this has emerged in the last 12-ish months. And to the point now, going back to valuation, we really have the way that people raise money 2, 3, 4 years ago that's at odds with what major large investors are seeing in the market opportunity now. Like they can go and fund two people in a garage with agentic AI, and that company can generate a product that's almost equivalent to one that spent 30 million getting there. And so you really do have a very different, I think, a market environment, and things are just evolving quickly. So I think that valuation thing principle, I think, is worth mentioning. But on the forecast side, it's just next level on everything, I think.
So Johnny, what I'm hearing is you're running the most complex transaction level detail AI modeling structure to be able to do this granularity, right? And your workbooks are all 30 megs, and I'm sure your team loves to open them every single month, right?
Yeah. Well, I think concurrent with this is the whole, again, to Ria's points about how it's not just tech companies having to absorb this AI opportunity. If you read the market, and everybody in this market is targeting service companies, legal, accounting, and everything. And so we're having to respond to that internally too, not just on a per client basis, like how can we optimize certain tasks, but how can we really revolutionize our operations to take advantage of this? And I think that's when you now running around with agentic AI and MCP and access to the data sets, like the way that you've done modeling, I think is really going to evolve quite rapidly as well. And I would certainly expect that agents and are going to form part of my monthly modeling workflow going forward. I mean, they already are to some degree, and I'm having to expand that quickly. So I can take advantage of this extra data and depth, and then I can still deliver something on like what is a requisite timescale. And you can need to take advantage of this technology to get there.
Yeah, I think maybe let's go a click deeper into agents. And then Riya, I want to come to you with our last couple minutes together and give the audience some like actionable next steps as you think about this evolution if they're not doing this today. So Johnny, let's go back into this agent. Like, tell me, you've got all this AI usage data, like what's an agent doing for you? What are you getting out of it? And what are you serving your clients with in this information?
Yeah. Well, I mean, I think this is all still pretty I don't have like a full built out answer for that. I think that what we're trying to do is figure like our value when we think of what we bring in terms of finance expertise is it's knowledge, experience, and skill set and process in a process, and be able to react to what is usually insufficient information and make a decision based upon that. And in working with agents, I think it's about codifying that knowledge in a way that the agent is informed and can give you a recommended answer without you having to go through all the steps to get there. Then you can look at the answer and decide, okay, is that appropriate or not? And so we're looking at a lot of the processes in our firm, which everything's pretty much client touching in some shape or form. But we're looking at those to see where can we optimize, where can we get, and to really take advantage of the extra data available. And agents provide that potential. So we are working a lot in it. I don't have an answer for exactly how that's going to look, other than we're evolving as we speak.
Yeah, no, that's great. Riya, let's come back over to you and let's bring it home with our last couple minutes together today. So we talked a lot about token costs, changing billing models, internal use cases versus client facing and billing, all of these like fun topics that for an internal finance team, like maybe if you're a lean team, it's just one person and this can be overwhelming. Like
Yeah.
give the audience a place to start to say, if you had to focus on one thing first as a AI focused company, like where do you guide people and clients and prospects on their journey of what's going to have the biggest impact today?
One
One
thing,
thing.
I think the right place to start is definitely to figure out what the right pricing model is. And then as a finance team, make sure that you can bill for it, make sure that you have a sensible approach to revenue management, reporting, revenue recognition, etc. And I think as we've discussed today, like there are always going to be trade-offs if you make a certain decision on how to treat that. But it just basically warrants a sensible discussion internally on actually, if I take this approach, how should I then maybe adapt my retention reporting, or what is my approach to this going to be? Because really, ultimately, everything in revenue stems from what's in that contract upstream and how you design that contract. So being very intentional about that with the sales org, and then obviously having the tooling or systems in place to be able to make sure that all flows through across the order to cash workflow. I think it really is as simple as that. On the agentic automation piece, just one thing I'll add here is that we're very excited about the agents that we're building in the order to cash domain. And I think there are a lot of places where there's real work to be taken off someone. You can have that leaner team. You can have a lot more operational leverage. But there are certain things, and I'm sure you guys feel the same way to Aleph, where it's so important that outcomes are deterministic, that actually, like, we don't use LLMs, for example, to do billing calculations. There's just no room for even like 1% error there. There are issues where LLMs can hallucinate when it comes to board reporting or analysis on numbers, and therefore this is not a plug for Aleph per se, but I guess really what I'm saying is it can sometimes be dangerous to do these things directly in Claude. Whereas actually, if you're working with an AI native tool in the space who are leveraging agentic automation, they're also putting in place the right guardrails. They're using agents in the right part of the workflow, but not necessarily, but accounting for the fact that actually this is inherently a sort of probabilistic technology. So that's what I would maybe close with.
Yeah, no, that's great. Thank you for the plug there. And I think the last question we'll close is from Suba in the Q&A. Johnny, probably for you, like how do you advise or how do you work with clients of understanding their AI costs related to like what is a COGS component versus what's OpEx? Like how do you think about like that whole forecasting and analysis and ultimately what ends up back in the books?
Yeah. Well, it is. I mean, going back to the discussion we've had before, is about having an understanding of the way that the product works and how the company or client operates. And I know that's very high level, but the way that we've done it to greatest effect is when we've got that we've been able to have those conversations internally to really understand, and with somebody who has that context and knowledge about how the product works inside the client firm, that can say, oh, well, these costs are attributable to that work or that transaction that's happening, and this is where we're incurring this work for R&D type purposes, etc. And you really need that superior knowledge to then segment out on the resulting costs. And this existed before AI. I mean, AWS or DigitalOcean or whatever, like those platforms incurred costs for lots of different types of activity, and some portion of that was then you needed to try and figure out what the COGS thing is. So this gray area where you had to have judgment has always been there. So I don't think the formula for success in that has changed very much. You just have to, the company has to know what's going on, and you as the finance people need to know who it is that has that knowledge. And that, I think the tools support that, but they're not going to replace that. I don't think.
That's a really great analogy, Johnny. Companies went through the same transition when AWS and Azure and all these other services started to spin up, and cost became one of the biggest drivers in understanding what you're doing on your own application versus what ultimately is used to serve clients is probably not any different than what we're talking about today. And I think that's a great framing for teams to be able to take back of, well, how did we approach this before, and knowing that we already solved this once? Or is it time for us to revisit our policies and say, actually, this is slightly different and we want to have a different approach, and how do we work through our auditors, whomever, to make sure that we have visibility and awareness. So really like that framing there. For me, like the takeaway that I hear for the audience is it's okay to change things a bunch. Like things are rapidly evolving in the world, and it seems like every single day something changes, but investing in the infrastructure and the processes and the visibility will help guide the companies and your all companies into success, and at least having that like great conversation starter with finance playing a really important orchestration layer across the organization feels like the headline of what I had hoped we had covered today. And Riya and Johnny, you guys did a great job of making sure we got there. And I know we went a little bit over our 45 minutes I said at the beginning, but we had some really great Q&A. And so I'll just close and say, first, thank you for everyone for joining us today. I think this was an ever-evolving topic, and we're really excited to have Johnny and Riya have been here today. As Lucas mentioned in the chat, if you want to continue the conversation with any of us, whether it's FP&A tooling, services, usage-based billing, like please feel free to reach out to Johnny, Riya, and myself either on LinkedIn or email. And then we're going to send this call recording out to everyone that attended as well. So if you have a colleague on your team that wasn't able to make it today, or a friend that works in the industry and you think this is relevant content, please feel free to share the recording with them. We're doing a bunch more of these over the course of the next month or so. I just want to say thanks everyone for joining. Thank you, Johnny and Riya, for being great panelists today. Hope everyone has a great rest of your day, and we will see you all again soon. Thanks so much.
Thanks so much, David. Great to be here.
Thanks, Riya. Take care.
Take care. Bye.